All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I'm here for a special live stream interview. Very quickly, folks, talking to anybody on Wall Street right now, I'll tell you, it feels to them like the world just got turned on its head. The once bulletproof market rally that we had over the past 2 years has shifted into reverse over the past month and a half or so, with stocks falling for weeks to oversold levels in the short term. And just when traders thought that a bounce was due, President Trump's Liberation Day tariffs sent the markets plunging by percentages not seen since the worst of the COVID levels. So what we're here to talk about today is what is going on and what's most likely to happen from here. We're very fortunate to be joined for this discussion by David Hay, the up until recently Chief Investment Officer and Principal at Evergreen Golf Call. He's just days into his retirement from that role, which means that he's free to be a lot more detailed and specific with us in his answers because he's no longer subject to compliance constraints. So I can't wait to hear his thoughts. Let me pull him in here. David, it's such a pleasure to see you. Thanks so much for joining us today.
Great to be back, Adam. Last time we talked was January 16th. It seems like that was a lifetime ago.
It seems like that was a lifetime ago. It seems like a week was a lifetime ago, to be honest,
True.
at this point.
Was it Lennon said, and sometimes there's weeks when decades happen. That's kind of how last week felt.
It is, and of course, it's still ongoing. So we may have another decade unfold over the course of this week. Look, a lot of questions here, a lot of ground to cover. If I can, maybe let me just start with a question I just mentioned there in the intro. What the heck is going on, David? What do you expect to happen from here?
Well, I guess, when you usually start these out, you say, give us an assessment of the global economy and financial markets. You asked me that last time, and I said precarious, which I think turned out to be pretty accurate. I would say now it's just chaos. And markets don't like chaos. I think one of the things that's been quite surprising is that prior to this utter chaos, we had a tremendous amount of uncertainty. And markets really don't like uncertainty for obvious reasons, and yet it just kept whistling past the graveyard up until February 19th, and then the bottom fell out. And so what I think we've really had here lately, when I haven't heard this term used, is that I think we've had a crashette. It's not an October 87 crash, which I remember vividly. I was in the business, I don't know, 8 years at that point, something like that. But we were down 15% in about an eighth trading sessions, or 12th, I guess. But so what would it be? 13 and a half hours, the market trading hours, the market went down 15%. That's a lot. I went back and looked at how many times has the market gone down 5% in 2 consecutive days. And since World War II, there's only been a handful. So there was the 2007, 2008, there was 2020, and then there was this one. I think if you went back, there was also the 1929 period, but the point is those are all really, really bad market environments. So we're in pretty tough company with those stats. So it's a very unusual time in so many ways. And we put out a letter yesterday saying we thought that we did a brief daily, which was more timely because it got out early in the market session. I had to rewrite my newsletter multiple times yesterday. There was so much price volatility going on. So we didn't get it out till almost 1 o'clock left coast time. So right before the market closed, we did our daily early, and it basically said we thought with the VIX touching 60, and 60 is a big number. And that, if you put in perspective, back in the Great Recession, COVID, we kind of hit 80, 90. During the yen carry trade crisis of last summer, hit 60 briefly. But you typically get really nice rallies, at least short term, when you have that kind of a VIX level. I think you may even have a visual on the CNN Fear and Greed measure, which is also very indicative that a rally was likely. There you go. Thank you.
You're welcome.
And so we've had that. I mean, this is kind of the classic setup for when you get these short-term rallies. Now, I think what people want to know is this like last summer, where you had that kind of flash crash? The Nasdaq was down 13% in just a few trading days. S&P, I think, was down 9% at the low, so not nearly as much as this time. But we had a nice rally after that, and of course, that rally really picked up steam starting at about early September when the market began to discount, ironically, the Trump election or re-election. And then it continued right up until basically February 19th. And there was something like $6 trillion of wealth created during that, what I call Trumphoria. but I think the Trump 40 was greatly overdone. And you and I, in looking, I have my outline from our chat back in January. We actually had a number of prescient views at that point, including that the market was way too complacent about tariffs. So I think that was actually a pretty good podcast. Even though I know you got some pushback, a lot of your viewers don't like to hear any words of caution, even if they're hedged or balanced. So anyway, it's I think we're in a very pivotal situation, and I'm sure you'd ask me more questions, so I don't want to steal your thunder.
No worries. Well, look, it's funny. Middle of last year, it seems that the market just fully embraced the no landing scenario, and worries of recession just disappeared from the headlines. All of a sudden, now that we've been going through, and I like this term, this crashette, or to mix both your terms together, this crashette in Trumphoria that we've experienced. All of a sudden, concerns of recession are now front and center again. And if you look at things like copper, it's been getting beat up. If you look at oil has gotten destroyed, right?
Tell me about it. That one has not been fun.
I bet. So I guess let me ask you this provocative question. Given the uncertainty that's being created by this tariffs, and even if they get resolved at some point, we're already hearing reports that companies are canceling orders, reining in their spending because of all this uncertainty here. So is this becoming a fait accompli? Is a recession inevitable at this point?
Well, inevitable is a very absolute word. I would just say it's quite likely and getting more likely. I noticed that the Goldman and JP Morgan have been upping their odds. I think Goldman's now at 45%, and that's a two-click. I think they've gone from 25 to 35 to 45 pretty quickly. Seems to me that we're somewhere in the 80 to 90% range. I thought we were actually headed to a recession even before this happened, but now I think the reality is the U.S. stock market has a big impact on economic activity, and certainly at the higher end. And it's like the higher end generates something like 60% of consumer spending. Just as a little anecdote, I just got an email before we started from a client who is planning to buy a Porsche, and the cost of his Porsche has gone up 50,000, or is going to go up 50,000 because of the tariffs. And he's like, "Well, I'm not going to do that." And of course, that's just a person, but think about companies. And so I think the ripple effect of this has barely been felt. So I think it's going to get tougher. That's why I would say that yes, the market was oversold. Yes, the market was going to rally, but I would not run that rally too far. I think there are definitely areas of the market that are extremely undervalued and have great long-term return potential. Most of them commodity related, because there's such a pervasive belief that with a recession coming, commodities are going to get clobbered. Well, they've already been clobbered, and particularly when it comes to oil, what you're going to see here very soon is a supply response where producers are going to cut back. And so it's the classic cure for low prices is low prices. But it's going to be I think it's going to be very volatile. I don't think it's going to be a lot of fun. I think the odds are pretty high that we're going to have a true recession, not a one of these like COVID where you blink and you missed it. And I think probably along with that, kind of a grinding bear market. But I don't think people should be suicidal. I think they should just be realistic. And the fact of the matter is that some of the greatest market rallies of all time happen within bear markets and recessions. You just have to remember that they are fleeting. And when you get these big moves, and I think today is just the start of it, and I have no idea whether it's going to go up 10% from the low, S&P, or maybe 15% for NASDAQ. I do think some of these beaten down areas are more likely to go up 20, 30%. But if that happens, even if you say, look, I really like Exxon long term, or EOG or FANG or whatever it is, I think you got to take some serious chips off the table if you do get this oversold rally that carries further than it has so far.
Okay, and the folks I've interviewed recently, Lance Roberts being chief among them, is saying that, agreeing with you, saying that we're sort of in a sell the rips environment now. So as we potentially have these rallies lighten up, because the potential for lower prices later in the year is high enough that you want to try to start reducing some of your exposure, but try to do it when the market's going in your favor. So you talked about a grinding bear market. I mentioned in the intro, David, and again, congratulations on your newfound retirement. But you have had a long and very successful career in investing. You know, a lot of people watching here, you know, some might be young enough that they really haven't experienced a grinding bear market, because we've had such a, you know, over the past decade plus, we've had so much intervention that whenever the market would get a little wobbly, you know, the rescue team would come on in. Just explain to folks what a grinding bear market looks like, and I guess in your answer too, where's the money to be made? Is it to be made on the short side, which I know comes with its own risks? Is it made trying to play these rallies that you mentioned, which are fast, or furious but fast? Or is it made by just surviving, keeping your powder dry, and then deploying it near the end when you've got really good valuations and you can catch the next bull rally?
Well, I think your last scenario is probably the most realistic for the bulk of people listening to this or watching this.
Mm-hmm.
I think the shorting part, which I do personally, I never did for clients. I mean, we use some inverse ETFs occasionally, but very rarely. But shorting is extremely hazardous. It's nice at a time like this because you get these, you know, when the market's going up, you get the capital calls. So like margin calls, you have to pony up more cash as the market's rising. When the market comes down, particularly when it comes down quickly, which it so often does, then you get these inflows of capital. And to me, that's one of the biggest advantages I've found personally in shorting, is that you get this torrent of liquidity when most people are lacking liquidity, and you're able to buy when prices are really bombed out. So, but it's just such a hazardous area. I think if you do that, is a lot of my readers and some of the people maybe that are watching your show or also read our newsletter, we're really big on breakouts. And if you're in a stock, you're short a stock that's breaking out to a new multi-year high, and we use 3 years as kind of the minimum, but the longer it's been in a range, the more meaningful the breakout is. You got to cover. And if you do that, if you're shorting around a high, around a 3-year high, and it breaks out, you're not going to lose very much. You have to have some kind of sell discipline, which I've learned the very hard and expensive way. But again, I don't think that's what most people should do. I think the problem is that if you look at the statistics from, say, Michael Hartnett and looking at the entire population of the Merrill Lynch investor set or base, people have very little cash. They have very little bonds. And what's happened is that we're at all-time highs in terms of household exposure to equities. And guess what? We're also at all-time highs in terms of age. You know, like me, who's soon to be 70. You said I had a long career. Well, when I started in the business, Jimmy Carter was in the White House 46 years ago. So it's a very, very long time. And I've, seen an awful lot of cycles, but we have to realize that if we look back even before that, if we go to, say a century worth of market data and economic data, what we've seen the last 10 years is anomalous. This is not the way it works. It doesn't work where the market goes up almost all the time and where you have these tremendous federal deficits, year after year, which we know that it artificially boosts economic activity, but it also artificially boosts corporate profits, which conveniently Wall Street strategists have just ignored. Now, you got John Hussman, who I know you've had on your show. You guys did a great podcast, I think, last June, right before the summer convulsions. And he's been on this theme, and it's just true. That's it. I think it's the Levy-Kalecki equation that goes back about 100 years, that if you have a surge in government spending, it's like rocket fuel for corporate profits. But clearly it's unsustainable, and now we're actually seeing concrete action trying to reduce it. So far, as you probably have seen, there's no evidence of it. The U.S. federal deficit's annualizing, the last I saw it, about 2.8 trillion, even higher than last year.
Yeah, it's when you compare it to the first, I can't remember the fiscal year of the government, but if you compare it to previous fiscal years when we're this far in, which I think it's like, 4 or 5 months we're in so far, it's the highest it's ever been.
Yeah, the fiscal year 2025 started on October 1st. So you're right. We're something like five months into that, but you got to believe that at some point these cuts are going to bite, and we're going to see the federal deficit come down. Now, the flip side of this, and this is what people like Jeff Gundlach are always saying, yeah, but what happens to a deficit in a recession? So if we are going to go into a recession, won't the deficit blow out? So you've got all kinds of countervailing forces at work. You've got these massive tariffs, which I guess on China are going to run as high as 100% if they're instituted as promised. And, that will definitely generate some revenue. It won't generate nearly as much as hoped, because what's going to happen, of course, is imports will go way down, right? The higher the tariff, the less the imports. So it's kind of like raising marginal tax rates. You don't get as much revenue as you think you would because it affects behavior. But we're very unlikely to see a major decline in the deficit, other than maybe temporarily before the recession kicks in. But I mean, it's possible we could go, 3 trillion, 3.5 trillion in federal red ink during a nasty recession. So and the tax cuts are supposed to still happen. It's bizarre. So many things are just like we've never seen before.
All right. Well, look, I want to stick on the recession for a bit, but I also want to ask you kind of an optimistic upside question. Before I do that, though, I feel I got to put up this user comment saying you're holding up well at 70, Mr. Hay. So,
well, it's hard to believe. I don't feel like I'm 70, but that's what my driver's license says. So,
all right. Well, at least
gotta believe it. But thank you.
I hope you're liking the love from the audience here.
I appreciate it.
All right. So, you had sent me over some charts and some data. One thing I want to show here, if I can find it, here we go. Challenger job cuts, right?
Right.
So you can see we have this, massive spike here in recent months, which, there's a pretty good argument to be made prior to Liberation Day that the economy.
You mean Obliteration Day? Wasn't that really what it was?
Obliteration. That might be what it's known as going forward. But there's a pretty good argument to be made before that the economy was slowing down and the country was approaching recession, or the risk of recession was growing, right? Obviously, Liberation Day, a lot of people feel like that's not even a push towards recession. It's like a mighty shove, but time will tell. We sort of had this blink and you miss it recession during COVID. And I don't mean to diminish the people that lost their jobs during that, but then there was a massive scramble to hire everybody back, and there was all the rescue efforts that came along with it. I get the sense that you feel like this recession that we're going into could be more like the recessions of old. I graduated coming out of one in the early 90s. So we had one in the early 80s. You probably remember the ones in the 70s better than I do. So, do you just help people understand what that feels like? I know you don't know, but is this going to be measured in quarters? Is it going to be measured in a year? Is it going to be, something that people really need to kind of hunker down for? Meaning, if you lose your job, you might need to expect you might be out of work for half a year, et cetera, before the economy picks back up. Is it that type of recession you're thinking of?
I think so. And again, I want to be humble and say, emphasize the think part of that comment. It's none of us know. And, a lot of this depends on a very mercurial personality in the Oval Office. And what if he does decide to back off on tariffs? I've been listening to your podcast lately, and I know you believe he's serious. And certainly his actions recently vindicate your views. And you said those before he launched into this, this really unprecedented trade war. I mean, you look at the increase in tariffs that are projected. I mean, they're going to go above what they were in the 1930s with Smoot-Hawley. This is big bad stuff, and it doesn't seem like it's just negotiating posturing. Now, there's maybe some of that, but I think what you and Brett Johnson talked about last fall. He's the dollar milkshake guy, right?
Yes.
Brett Johnson.
And by the way, Dave, I was just going to say, you are a better student of my channel than I am. So thank you. I'm honored that you watch it as much as clearly you do.
I do. I watch every one. And and you guys both said, I think Trump is going to take the pain hard and early. And that's exactly what's happening. I heard another podcast, not with you, was with one of my other buddies. And this guy that he had on there was saying, wow, I just can't believe how fast he's moving. It's just so chaotic. And it seems like it's uncontrolled or unplanned and, just kind of shooting from the hip. But I think this is exactly what he was intending to do, is to move fast, break a lot of things, and then try to pick up the pieces in a year and a half, something like that. Hopefully they're going to, for his party's sake, try to have things looking better before the midterms. And actually there is a template for that in terms of what Ronald Reagan did. And I think a lot of folks forget. Again, I'm old enough to remember I basically just started right before Reagan. So he was elected in 1980. His policies started kicking in 1981. And 1981 was a nasty year for the economy. It was a nasty year for the stock market. But then by 1982, interest rates were coming down. The economy was healing. The stock market launched into its epic bull run that you could argue lasted until, maybe until February 19th, with just a few of these flash crashes along the way, including the crash of '87, which that was a 40% decline. But again, it was very quickly. So to your point, my gut feeling is this is going to be a longer, drawn out process. But you look at Argentina, and I think that Trump is kind of looking at the Reagan playbook and the Milei playbook. He's the president of Argentina, who in a year did get things turned around pretty quickly. Now they're hitting a few roadblocks here recently, but it could be that a year from now things will be looking better. But still, a year is a lot longer than what most people are used to in terms of tougher times. I don't think this is going to be a 1930s type of replay where it's basically a decade-long depression / recession with a recovery kind of sandwich in between. So but it's definitely a very radically different environment than what we've been used to over the last 10 years when we've been so unbelievably spoiled and pampered.
All right, so I just want to let folks know here, given the probability you put that this could be something that's longer than one of these blink and you miss it recessions like we had during COVID. Folks, you may have heard me mention this resource. It's totally free. It's a guide that I published years ago, but I've now updated. And it basically just walks you through a number of steps that you should be taking now if you work for a paycheck before the potentiality of you getting laid off, just things you can do to reduce your risk of getting laid off or to be in a better position in case you do get laid off. And then it has a bunch of things that you should do immediately after getting a layoff notice. So hopefully that's a useful guide for folks. Hopefully you don't need to use it, but just in case, it's good resource to have in advance. All right, David. So let me ask you this. I'm going to try to pull up a comment I just saw here. Okay, it's simple. Idiot orange genius has confused tariffs with trade deficit. Dumb as paint. Let's take the partisan out of that for a moment. There's been a lot of discussion about Trump's big chart that he pulled up and the formula that his economic team used to create these quote unquote reciprocal tariffs, where everybody was expecting it to be truly reciprocal tariffs. Okay, country X has a tariff of X% on us. Well, we're going to charge them X%, and that was going to be it. But the Trump administration rolled out this this equation that really has sort of stumped a lot of people, where they're really looking at the trade deficit and basically dividing it by half. And a lot of people are saying, well, look, just a trade deficit in and of itself isn't a negative thing. You can be getting screwed if you have a trade deficit with a country, or it could be a very natural outcome of the best way for you two countries to trade. So I guess first question for you is, do you think that Trump or the Trump administration made a mistake either in their math or in their communication rollout of this, in all of it or in none of it?
I think it's a mistake. I don't think it's the right way to do it. It seems like so many things that Trump does is kind of ham-fisted. I mean, I get what he's trying to do, but it's too indiscriminate in my view. But that's kind of his style, and his is kind of like, well, I'm just going to hammer people, force them to the negotiating table. We'll pick up the pieces later, and again, I think it just fits within this mosaic of where he wants to go fast and break a lot of things, and then come in there later and figure out what's worked and what hasn't worked. And he's not your normal politician. He's not your normal businessman. Even he's in a very unique class, and it's got good things and bad things. I think right now we're kind of seeing the dark side of that. So but one thing to bring up too that's kind of related to this that I think it's overlooked from the stock market standpoint is that when we run say $1 trillion trade deficit, which is about what it is, we also have to have $1 trillion capital account surplus. So in other words, that money that we send out in exports comes back to pay for exports, comes back in the way of reinvestment in this country. And it's not going into treasuries, as you know. What it's been going into has been basically the large cap, mega cap tech, like say the Magnificent Seven and kind of the next tier down. So right now, foreigners own something like $18 trillion of U.S. stocks. And if those capital flows are going to be impaired or even reverse, I think that has negative market implications. And we're also used to saying the stock market's 20 or 30% above normal. based on PEs or price to sales or GDP to market cap. But we're not used to the fact that we could actually go 20 to 30% below. And that's what happens when the conditions go from, like way too good to not so good or even adverse.
So in your term there, grinding bear market, given what I do for a living, I talk to a lot of guys like you who have had fairly long careers, and they generally tend to say like a true bear market only ends when nobody wants to buy stocks anymore, right? Where they've just taken so much pain. They've had these bear market rallies that then fade, right? And they just decide, you know what, stocks are a losing game now. I don't want to own these things anymore. Do you feel we'll hit that capitulation point at some point as this progresses from here?
It's probable. I mean, that's what happens after lengthy bear markets. I mean, with these short ones, even if they go deep, even if it's 40%, but it only lasts for a few weeks, that just doesn't really impact people too much. It almost like reinforces the idea that, okay, well, even if we go down 40%, then we're right back up. It's like, well, what's to be afraid of with that? But when the market stays down, because you just get kind of a sequence of bad news upon bad news, and that certainly happened prior to I started my career in '79, but in say the 1973 to '74 period, and we'd gone that prior to that was the Nifty 50, so it was a very frothy market environment, very narrow, similar to what we had now, and then it was probably a year and a half, maybe close to 20 months of bad times. And you got a recovery. It wasn't much of a recovery, and then another down, and it was a very choppy period. You're probably aware from 1966 to 1982, the stock market went nowhere. Actually went down from, because it got close to 1,000 in 66. It was about 800 in 1982. So in real terms, it just got slaughtered. And that was kind of a stagflationary environment. And it came out of boom times in the 60s, better boom times, healthier boom times than what we've had here recently. And that was one of the things you and I talked about back in January, was the possibility that we were going stag, that we would have stagflation. Mm-hmm. And I think that, we had whiffs of that before, but with these tariffs, I mean, I think that's where you can get, at least temporarily, of some kind of lasting stagflation. And I'm sympathetic to the view of people like Daniel DiMartino Booth and David Rosenberg, that you're going to see a recession which will eventually lower prices. But that really doesn't take into account this tariff playbook, which for a while is going to drive prices up significantly. And you can say, well, it's really kind of a stealth tax. And as long as the Fed doesn't monetize, doesn't print money, then that will pinch. So if people have to pay more to import that portion that I was talking about earlier, then they're going to spend less on other things. So, and that's why it could end up being contractionary and eventually actually lead to a fairly steep fall in inflation. But early on, I think we are looking at some stagflation.
All right. So it's interesting because that word's been kicked around for, I don't know, past couple of years as inflation started to spike. And I've asked this question on this channel a lot about, what's the danger of stagflation? And clearly we haven't entered it yet over the past couple of years, but it sounds like you think odds of it are now increasing primarily because of the tariff structure, right? Which will artificially keep prices up and potentially trigger the recession.
Yeah, I'd say that's the number one driver, but I think there were some stagflationary impulses before. I mean, clearly the Fed has not been successful in getting its target rate down to 2%. So it's been kind of maybe mild stagflation. I think the tariffs are the number one problem for the low inflation thesis, but I think it's just delaying it. I think ultimately we will see inflation come down to a relatively low level if the recession is lasting and relatively severe. Mm-hmm. Can I make a positive comment about the market?
Yeah, real quick. Sorry, just to mention this too, so you can include it in your answer. So, I find with stagflation, folks sometimes sort of have different definitions of it. And I know Lance Roberts, one of his requirements is high unemployment. And that's something we haven't had yet, at least not in the official data. But I get the sense from you think that will be, there's good probability that will start kicking in if indeed we have the recession that you think may lie ahead.
Yes, and one of the things, I made a big deal about range expansion with the stocks and sectors and the overall market. But if you were to put that Challenger survey back up, you would see that there's clearly a multi-year breakout going on with that. And that's actually true of some of the other charts. So you can see that there was kind of this fairly tight range. This goes back. This is kind of the time frame we were talking about 3 years. So just coincidentally, it's right. I see this so often with macroeconomic data, which is why I'm kind of like believing that these breakouts are almost like fractals in nature. There's something that kind of says it's something that kind of repeats throughout human experience. And we'll see some other things in those charts that look a lot like this. So yeah, I think there is a major breakout to the upside, which in this case is not good, and things like this. So yes, and yet the most recent jobs number was again relatively healthy. And I know Anna Wong from Bloomberg, who you had on here recently, she's kind of skeptical and of these jobs numbers, and she should be. And she understands that there's a lot of manipulation and assumptions, and then you get these revisions which have been consistently downward. And as you well know, it's kind of an arcane factoid, but the birth-death model that the Bureau of Labor and Statistics uses to estimate business closures and openings is distorting these numbers, especially when the economy is turning down, because it's still assuming that you're forming businesses when you're actually closing businesses, and then the numbers get revised. And really the fact of the matter is, and I know Anna talked about this, is that a big reason, probably the biggest reason the economy has avoided recession, even though there was an industrial recession, it's still ongoing, there was a brief earnings recession, but there hasn't been a true recession. And who's to be surprised when you had this massive amount of fiscal stimulus, basically $2 trillion a year of red ink, which makes it very difficult to have a recession. But if that's going to come down hard, which I know that if a recession happens, that pushes it back up. So you get this push you pull me kind of thing going on. But still, I just don't see how we can continue to sustain $2 trillion annual deficits.
Yeah, and it's, as you said earlier, the administration is at least verbally committed to trying to tame that too, which is a very new factor. Real quick on the most recent payroll numbers, Anna had actually predicted that they were going to be pretty robust. And one of the main reasons for that was because of all of the front running for the tariffs, that there's just been a lot of economic activity to try to, make all that happen. And so the demand for workers was still pretty robust. She does think that, we'll start seeing things cool off here. And I'll let you comment in just a second. But she said that I think her forecast for the end of the year is 4.7% unemployment, which is still fine historically, but it's high relative to what we've seen in previous years. And I remember interviewing her, not this last time, but the time before. I'd asked her, when's it going to start feeling like a recession to the average person? And she said 4.5% unemployment. So 4.7 is obviously higher than that.
Well, I think the low was 3.4. So if you go from 3.4 to 4.7, that's over 100 basis points, over 1% of increase, which I think if you go back and look, that just, you never avoid a recession with that. And I think she's exactly right. That's one of the points we were making, that, because a lot of things look kind of strong at the end of last year, beginning of this year, because so many businesses were trying to get ahead of the tariffs. So I think one of the more interesting stats out there right now is this inventory relative to new orders. And it's terrible. It's at a level basically that it's only touched in recessions in the past. So you've got high inventories, low new orders, which would reflect just what you described. And I think that's a headwind that's only being kind of partially appreciated at this point, with probably more impact to come. So it's there's a lot of things. We've been very, very fortunate for a long time, and there's been a lot of can kicking that's gone on. So we've been trying. It's been a long time since we had a real recession, and it used to happen every 3, 4, 5, 6 years. And really, the last time we had a true recession was 2008, 2009.
Right.
So we are really overdue.
And I believe you feel this way, but I mean, it's the reason why it's called a business cycle, right? I mean, it's like the seasons of the year. Each season has its function, right? And if you try to push off part of the cycle from happening, eventually reality will win out. But because you have delayed it, the force with which it arrives is a lot more destructive than it otherwise would have been.
That's very well said, and I think people just don't get it, or they don't want to get it. So that's why I would say that it's a good idea to be selling into these rallies. The bullish point that I wanted to make earlier about the market is that clearly on Friday and into yesterday early on, it was looked like a global margin call. And people go, well, what does that mean? Well, it's basically forced deleveraging, where you have these, whether they're leveraged ETFs or whether their institutions have been using a lot of debt to goose their returns. When they start being forced to sell their positions, then they start selling kind of everything. And sometimes to avoid losses, they sell what's held up the best. And you just look at some of these midstream energy names on Friday and yesterday that are very defensive business models and had actually been doing really well. Were not particularly overvalued, still have great yields, and they just, it was like down 7%, 8, 9, 10% across the board on Friday, kind of midday Friday, and then down hard again yesterday. So that's just, I've seen that happen repeatedly during these forced liquidation periods, and those are good buying opportunities. And so that's why I think that we have set up for a bounce. You and I talked about that even a month or so ago, based upon the Vincent Delaware work of the target date rebalancing, and sure enough, we got a nice little rally. He didn't think it'd last too long. I didn't think it would last too long, and it didn't. But and I don't think this one will either. But we could certainly be in a, say a 2 or 3 week uptrend that might suck a lot of people in at an adverse time.
Well, that's kind of the role of a bear market, right? It's to have as many people lose as much money as possible. So you got to keep pulling any potentially optimistic people back in, so you can pull a rug out from under them again.
Absolutely. They say the bear markets return securities or stocks to their rightful owners.
Okay. So I want to ask you about one other potential downside, then I want to ask you about an upside. Real quick, I don't know if folks saw this, but if folks follow my X account, you'll see oftentimes I'll post a photo of my wife pulling a fresh loaf of sourdough out of the oven. She's been back at it recently making bread. She just brought me a slice of bread fresh from the oven while we're here, David. So that's true wealth right there, folks.
Yeah, I was going to say, at least somebody in your family is still going to be making bread.
Yeah, exactly.
You'll do fine.
At times like this, yeah. So everybody knows who the bread maker in the family is. All right. So, David, I think you have had concerns about this, as have a number of other folks I've interviewed over the year, saying that even before we had this downtrend start, a little over a month ago, they were looking at the forward earnings estimates for the S&P and just saying there's no way companies are going to hit that, right? And now we have had some of that froth come out, over the past month plus. But I was going to say some. I don't think it's enough to justify the current forward earnings estimates. So, is that a shoe that you indeed expect to continue to drop from here, and amidst the other shoes that are dropping?
Yes, I'm not sure it's going to be a huge shoe, just because the history of earnings estimates is that they're almost always too optimistic, and as the year goes on, they get consistently ratcheted down, even during so-called good times. So it's not going to be a real shock, but it could be that the magnitude of the decline is a shock. I mean, if we went from assume 10% to positive to -5 or -10 negative, that would qualify as a shock, and that's entirely possible. We could be seeing earnings actually fall. I mean, I think that's to be expected if we have a recession.
Okay, but it's not something that it's an additional risk, additional concern, but it's probably bigger concerns to focus on than just that alone.
I just think it's a derivative concern.
Okay.
The primary concern is if there's a recession, because you know this, but I think a lot of your viewers may not, that you can have a bear market without a recession. But those typically are kind of -20, -25. If you get a bear market with a recession, that's when you get the -30 to -50. If you go, oh, -50, there's no way that can happen. Well, it happened in 2008, 2009.
Mm-hmm.
It happened from 2000 to 2002. It happened in 1973, 1974. And of course, in the 1930s, it was more like 80%. But again, I don't think we're going to have a 1930s, at least in nominal dollars. I mean, and I think that's one of the things that doesn't get enough focus, is how much of what we've seen in terms of market return has been offset, or has been, I should say, driven by inflation. So just to give you, and you're aware of this, I'm sorry, I don't mean to be being pedantic or anything, but
and look, not everybody is, so it's always good sometimes just to reiterate the obvious.
So one of the most amazing factoids is that if you believe that gold is real money, and that's what J.P. Morgan said 100 years ago or so, that gold is money, everything else is credit. So if you value the S&P 500's returns or discount those returns in gold, we've been in a 25-year bear market. Gold has drastically outperformed the S&P 500. This was true even before the recent decline. So it's even more true now because gold hasn't come down very much. So it's what I would call a money illusion, that a lot of these returns have been due to inflation or currency debasement. And on the currency, we haven't talked about the dollar, but you and I were both concerned that the dollar was inflated at the beginning of the year. I got my oh, portfolio assistant that just walked in the background there.
It's a good-looking dog.
He's one of three. Our house, it's 3 dog night every night, like the old rocker. So anyway, if gold has held up extremely well relative to equity prices, as we know, but it also gives us a sense that so much of what we've seen has not been real. It's this money illusion that's been going on for years.
Well, if folks caught my recent interview with Lawrence Lepard, they'll get a lot of validation of that exact same point there, David. So, all right, look, I'm looking at the tremendous number of questions I have left and trying to see which ones we can pull in with the time we have left. Let me ask you this, just on an optimistic side for a moment. So obviously, the Trump administration is saying, "Hey, look, we've got a big goal we're going after that we think is going to revitalize the American economy and is going to make whatever pain we're going through here in the short term worth it." Right? And it's interesting. I've been listening really close to the Trump administration, and I kind of made my point the other day about I think that they're approaching this sort of like a World War II war commitment, and I think that's only been reiterated by his cabinet's public statements since, and Trump's himself. But one, could this be worth it? And could these policies, many of which borrow a lot from Reagan and whatnot, I mean, could they create a great opportunity for investors a year or 2 years down the road, where we get through the depths of whatever might lie ahead of us, but then there's good values to buy in at, and then we have a big economic growth tailwind? Love to hear your thoughts on the potentiality of that. But in the short term, could all of this current angst reverse really quickly if Trump were to come out and say, "Hey, look, we've just struck a whole bunch of deals here, and we, surprise, surprise, we just struck a big deal with China and we got what we wanted"? I mean, is there the potential that this crazy 4D chess power move he's just made, maybe works out in the near term?
Yes, I think that could happen. I would say that if it does happen, where will you get the best returns? And I think that the good news is you can get the best returns from those securities, those sectors of the market, which have been most pummeled over the last couple of years. And that would lead me back to a lot of real assets, hard assets. Personally, I think that it's going to be, no matter if your scenario turns out to be true, which I hope it is, then we're still left with this massive debt situation. And maybe you could say, well, the deficit's going to not be increasing at 2 trillion, maybe it'll be 1 trillion, but we still have all this accumulated debt. That is a big problem. I mean, the difference between Trump and Reagan is that Reagan, back in the early 80s, had a very low debt to GDP. It was about 30% versus now we're 130%. So we got a 1 in front of the 30. So it's, how do you get out from under that? And I think the only way you can do that is unless you're going to go through years and years of, kind of like what Greece went through, back in the 2000 teens, where they had basically a decade-long depression, but they finally got their finances restored. I don't think Americans will put up with that. I think that the politicians are going to resort to some kind of inflation to, if you run the economy hot so that you have nominal GDP growing well above the interest costs. So you gradually, that's actually happened in this country after World War II. We had about at the same kind of debt levels at that point that we do now. And by the end of, by 1952, we'd gotten them down to about 70%. So big debt pay down from 1945 to 1952. And it was inflation that did it. So it's not without precedent. And it's maybe not a bad outcome. I think it's a pretty good outcome for younger people. I think who loses in that is the older generation like me, and particularly those people that don't recognize the situation and get stuck with a lot of bonds that get, basically, you don't lose in nominal terms, but you lose in real terms, which is certainly what's been going on for 5 years. It's been one of the worst bear markets for bonds ever in real terms, even in nominal terms. So I think you just have to be cognizant of the environment. That's why I think that these hard assets, and unfortunately, you mentioned copper, but even silver's gotten hit hard here. Gold's kind of the only one that has been hanging up there. I mean, platinum. Remember when platinum used to trade at a premium to gold? That's why you get a credit card, platinum card, gold card is lower than platinum card. Well, platinum's around 1,000, gold's 3 times that price. Palladium, and there's just so many of these things that are on the bargain counter. Back in September, as you know, I actually sent you one of my pieces that was bullish on natural gas, and the venerable Duberg agreed with me at that time that gas had the upside, oil was not looking as good, and gas prices have doubled, but they're still cheap compared to the rest of the world. Anyway, I think that if you're looking at a lot of these resource-based companies that have been talking about being nuked, how about uranium? Uranium has been absolutely nuked. I just listened to a great podcast yesterday, and with a uranium expert, the demand supply mismatch is like nothing ever seen. Then you put in the pricing, where the price of the spot market is so far below the real market, the contract market. So there's bargains galore out there right now, but they tend not to be. I mean, you look at some of these big cap stocks, you go, yeah, they've come down. Yeah, they sort of look good. I mean, but really, is Costco a great buy at whatever 45 times earnings? I don't think so. It's a great company, but there's a difference between a great company and a great stock. I know you got more questions. I should shut up.
No. Actually, you're taking it right where I wanted to, which is now kind of where the rubber meets the road. What should we investors be considering doing with our wealth here? And I'll let you say whatever you want, but I guess you would say, well, look, defense is probably not a bad strategy, right? Try to preserve that dry powder, as you said earlier. So presumably T-bills while they're still paying for something. And interesting that they had a 3 handle the other day. And if you want to comment on that in any way, please do. But so I imagine, it never hurts just to sit in safety and wait for the dust to settle. But seems like you do see some really good opportunity in a lot of the hard assets, these ones that have really pre-crashed here. I don't have the chart here, but I think most people have seen the chart of, I think Tavi Costa puts it out there, which is the ratio of equities to commodities, and it's at like it has been at multi-decade lows. I haven't seen it actually in the past couple of weeks. Maybe it's ticked up a little bit, given that equities have probably crashed harder than most commodities right now. But
I don't know.
Yeah,
at least not most commodity stocks. Commodities have not gone nearly as much as the stocks have. Look at Freeport. I mean, copper's not down that much, but Freeport's been crushed.
Yeah. So I guess with those stocks right now, do you see them as good buying opportunities, or do you see them as companies that have kind of pre-crashed? So if there is downside risk still to the general market, these companies will decline less than the average stock because they've already been beaten up. But so maybe like a dollar cost averaging going forward is a good way to get into these things. And even if they still go down for a while, well, you're accumulating at lower values, and then when the turn comes, you've got your position.
Absolutely. I'm so glad you brought up that term, which is, I think most people have forgotten dollar cost averaging. And I've even written that, I think it was Einstein said that compound interest was the 8th wonder of the world. And I said, well, if that's the case, then dollar cost average is the 9th wonder of the world. I may be getting his numbers off a little bit, but it is a great tool as long as you use it judiciously, because there is always the risk when you're using individual securities that you dollar cost average into the next Enron or WorldCom or, well, Rivian or whatever what was the one that electric thing that went down to Trevor? Anyway, when you pick individual companies, Nico, there you go. Thank you. Yeah. Rivian's still going for now. So that's the danger with individual securities. Now you can use the 3-year support rule to kind of mitigate that. That's actually, you can't lose big money if you follow that rule. But the other way is just focus on ETFs, where you're getting a lot of diversity. So you're buying a sector, you're buying a style, or you're buying the market. And dollar cost. Yeah. But how few people do that really, Adam? I mean, almost everybody does the opposite. And the same is true on the sell side. I mean, dollar cost averaging on the sell side is very important. You get a big winner, take some off, typically keeps going, take some more off. What most people do is, oh my God, I made a big mistake by selling that first batch. I better buy it back. So now they're buying at higher and higher prices. Eventually it breaks and they lose money. And so you're exactly right. I think that especially in an environment like this is a time to be buying, but buying slowly and judiciously. Don't buy something just because it's down a lot, because it could have been 100% overvalued and now it's 50% overvalued.
I like that. Buy, but buy slowly. And obviously the dollar cost averaging. Yeah, there are programs out there, like one of the ways in which I've bought a fair amount of my precious metals is just this monthly ACH, right? I mean, I don't even really think about it, but it's just happening like clockwork, right? And I'm trying to be better too about some of these asset classes where, again, it's just okay, it's the first of the month. I'm just going to put in, right? And I'm not trying to overthink it. I'm not trying to get too sexy. I'm just trying to let that force of nature, as Einstein, well, as you mentioned now, work in my favor. And I think a lot of other people can benefit from that as well. All right, David, I'm looking at the charts that you had sent over, and I'm realizing we haven't gone through all that many of them. And we don't have to go through them all, but I'm just curious, before we run out of time, are there any in particular you'd like to talk to?
Well, why don't you put them up, please, and we'll just go through. We can go through real quickly. I think we'll get the sense that what I was saying with some of these, that there's some breakouts going on. I think particularly you got the credit card delinquencies, right? Consumer delinquencies. So there you go. This is what I'm talking about. So this goes back, basically 12 years, and you can see there's been a major breakout to the upside with credit card delinquencies. And then if we go to consumer loans, kind of looks the same thing.
Yeah, I don't have the consumer loan data here.
Okay,
but
that's all right. Okay, so let's.
But to this point, and I'm glad you brought this one up, because we did say we wanted to talk about this. In that recent interview that I did with Anna Wong, a really interesting piece of the puzzle that she brought to the table there, right, was this concept of kind of grade inflation that has occurred with credit scores. And she says, a lot of lenders haven't been that worried, because they're saying, well, credit scores aren't in the danger zone that they got to back, right before 2008. And from the work that she's been looking at, she's saying, well, there's actually been some great inflation. So if you actually discount for that, they're actually not that different from where they were in 2008. And one of the big problems that opens up is right now there's information asymmetry, where the borrower has a truer sense of their creditworthiness than the lender does. So the borrower can go out and say, look, I'm not doing that well, so I'm going to go out and get another loan here. I'm going to borrow as much as they're willing to give me, and they're willing to give a fair amount because the credit score, quote unquote, looks good, right? At some point, she believes that the industry is going to start really waking up to this at scale, and then they're going to start tightening their lending standards, and that this is going to be one of those potential vicious cycles that could bring on a recession. Again, this was a worry pre-obliteration day, pre-tariffs. And so it's just one more potential, sizable shoe to drop here, which is that all of a sudden the consumer, the stressed consumer, and we're seeing all sorts of signs, and you just put up the credit card delinquencies there, that the consumer is starting to tap out. And if they can't get access to credit anymore, then that really could start impairing consumer spending, and we're a 70+% consumer spending GDP economy, and so so on and so on. It starts spiraling down. So, how worried are you about this?
Well, like you said, there's a lot of things, a lot of shoes dropping, and I would say, another way to phrase that is straws in the wind, many, many straws in the wind. And so I think we're getting closer and closer to our Wizard of Oz moment, where the tornado hits and the house gets lifted off, and it's yeah. There's another thing that
We're
is,
not in Kansas anymore.
not in Kansas anymore. You're soon to get relocated, and maybe a few states away, but and maybe to a not very happy state. But the consumer, you look at high-end consumer confidence levels, they're plunging, and that's what has been consistently holding up,
Right.
is that high-end consumer. And you've already seen the trade down effect, that where you get the wealthier people have been shopping at Walmart, and the people at Walmart went to Dollar Tree, the next level down, and then the people that were had been at Dollar Tree are just not buying anymore, which is why the dollar stores are struggling. And there's just tons and tons of evidence of consumers being under stress, and really, even prior to Obliteration Day. So I totally agree with Anna Wong. I mean, she, to me, sounded quite cautious. I think she's even talking about a potential 30% drawdown in stocks. But it won't be a straight line. There will be rallies. There will be
Well,
rallies.
let me ask you about this. So here's your chart here showing that stocks are at a record 29% of U.S. household financial assets. So basically at an all-time high, right? You mentioned this earlier. Now, there's some overlap here. Stocks are unequally owned. Depending on whose stat you use, it's somewhere between, the top 10% own somewhere between 88% and 93% of all financial assets, right? And the boomers as a generation own a disproportionate amount of them relative to younger generations, right? So to your point, the affluent consumer has really kind of been keeping the average retail spending supported, right? And I don't know if you saw my interview with Wolf Richter, who has said, look, this was pre-Liberation Day, but he said, look, I'm with everybody else. I think we deserve a recession, but he said, I keep watching the data and I'm just not quite seeing it yet. He said, my big worry is that there's going to be a big market correction because stocks were way too overvalued, and that could then trigger the recession because it would cause this negative wealth effect amongst the affluent consumer. They would constrain their spending enough that would start slowing things down. I think that's true. My guess is you think that's the same, and maybe we're starting to see the beginnings of that. But also to that point about being at record levels of stock ownership, a lot of that is in the boomer generation, a generation that in the past did not have nearly this much exposure to stocks as a percentage of their wealth, right? And so that could really create a big negative wealth effect, because these are people who are getting injured late in the game, right? So, if I'm 45 and my stock portfolio gets hit by 20%, yeah, it hurts me, but I figure, okay, I still got 2 more decades or so to make up for this. If you're 70 and this happens, you got to start cutting right away, because you don't know if it's going to recover.
Careful. I'm not quite 70 yet. That's not till October, but no, it's exactly right. It's what I was saying is that it's alarming enough that the U.S. households are so exposed to equities, but when you age weight it, it's just like, wow, this is really dangerous. You remember the old rule of thumb that you take your age away from 100 and that's what you should have in stocks. It was just a heuristic, but say, use 70 and you should only have 30% in stocks. And instead it's more like 60, 70, 80%. And it's great, when you have the market mostly rising and you have these very brief, flush outs, but that's where this grinding bear market becomes, I think, a systemic risk, because there is absolutely, you were kind of going with that earlier, that there's such a pull through between how people feel about their portfolios, and especially those with wealth. And again, that's where the majority of spending happens, is with the wealthy, even though they're a relatively small cohort. And you've also probably seen these linkages between the S&P and government tax revenues. So if you get the S&P down hard, then that's another thing that hurts government tax revenues, which is the last thing they need right now.
Right, especially like at the state level, right? Like state like mine, California, it's heavily dependent upon capital gains taxes.
And already running huge deficits.
Right.
And that was actually, since you brought that up, that was one of the things that I got from Vincent Delaware here recently, that if you looked at state spending was running very hot last year, something like up 13%. It's now gone negative already. Mm-hmm. That was state and local. We're so focused on federal, but there's a real reversal happening at the state and local level as well.
And things like Doge probably aren't going to help that either, right? They're cutting off a lot of things that were going, to states.
Sure. Good point. A lot of that federal largesse did flow to the states.
So I know you're a financial markets guy, David, but just real quick, thoughts on where the housing market plugs into all this? Because obviously that's on shaky grounds.
Yeah, great question. It just amazed me. That was one of my more embarrassing personal short positions last year, was XHB. But when it broke out, so there was a good example. It had a multi-year breakout. And I've learned, okay, don't argue with it. Just let it go. Mm-hmm. Covered almost all my shorts. It went nuts. And I thought, okay, this is crazy. It was like they were at all-time, like way, way above all-time highs when affordability had collapsed. And it just didn't make sense. So, now reality is set in and these things have been clobbered. Housing prices have started to weaken, but they're still really high. And I think it's going to take a huge interest rate decline, which I think will be difficult to get the kind of interest rate decline you need to revive the housing market. I did see a recent transcript. There was a summary of Ivy Zellman, who I know you've had on. And she was saying, although you've had more, I think, Melody Wright, but she's very negative on the housing market.
She is. And I'm trying to get Ivy back on. Her dance card's pretty busy, but just folks, so you know, I do have an active invite into her.
She's a popular lady, but she was saying she thought housing prices needed to come down 25%. And she didn't say when. That's always a smart thing when you're talking price changes, to not say when. But so I don't think, maybe you could say the building stocks have come down so far that maybe they're decent buys. I think they're back to just kind of fairly valued, maybe somewhat overvalued. But I think housing's got a problem. And there's no question. You hear this all the time, but this has been my big argument with the housing bulls is say there's like a 3 or 4 million unit shortage of homes in America. There needs to be more homes. Absolutely true. But they need to be affordable homes, inexpensive homes. And that's not what the builders have been building because the margins there aren't very good.
Right. And just to be super clear, and this is a little bit more of my bias, but I've asked it of enough housing experts that I think enough of them agree with me. I'm not sure. I don't think that we necessarily have a unit shortage. Like if you look at just units per capita in the country, what we have is an ownership distribution issue where you have a lot of people, mom and pop landlords, but also short-term rental landlords and increasingly institutional landlords who have bought up a lot of the inventory, right? So that if that inventory were to come on the market, if those holders were to start selling it, right, and they become available to just average retail buyers who want to live in the home, that actually could close the gap a lot pretty quickly. And we're already beginning to see that in key markets like Texas and Florida, and now to a certain extent, California. So, I would just caution people by thinking, well, prices can't come down because we have this 3 to 4 million shortfall. It's like, well, no, if inventory comes on because these landlords start dumping the properties, that could change things real quick.
That's a very good point. And I've been frankly surprised it hasn't kicked in yet. I mean, I know people were talking about the Airbnb effect a couple of years ago that, they were putting these things out on Airbnb and they weren't renting and that they were and the rates had moved up and they would start feeling the pain and start, dumping all these homes, but it really hasn't happened yet. But maybe it's just your typical lag effect that I know.
Yeah, and it is happening in certain markets.
Both of us.
Yeah,
Yeah,
I've
certain
definitely
markets
talked
for
to
sure.
Melody and a few others who have pointed to, and again, even starting here in California too. San Diego apparently is one of them. Okay, but anyways, I guess where I'm going with this is if the housing market actually does start to roll over, that's yet another shoe here that potentially could really create a national negative wealth effect, right? Because as I mentioned, stocks, the concentration of stocks is really shoved into the top echelon. Housing is much more widely owned, right? It's many people's biggest asset.
Absolutely. That's what made the Great Recession great, was severe problems in housing. And as you know, in many instances, I mean, if you look at most of these valuation charts or affordability, it's worse now than it was, back in 07,
right,
leading into the housing collapse.
Well, and that's where Anna's concerns come into play, where she feels that the repayment of student loans now, which is sort of the last moratorium to have been removed, right? That could actually kind of be a trigger of credit contagion going forward from here. So she's not predicting a 2008 style like the credit markets just seize up, but that, okay, I think there's 30 to 40 million student borrowers. And she says there's about 10 million of them that are now entering the danger zone where, their loans have gone into repayment, their delinquencies are spiking. It just doesn't look like they're going to be able to pay them. That's then going to trigger the lenders to start, realizing, hey, people are less creditworthy than we thought. They're going to start tightening credit standards, and then that's going to spill over, and we're already beginning to see it spill over into their credit card debt, into auto loan debt, and into paying off their mortgages, right? So we could see this rolling contagion of increasing defaults across sort of all consumer credit products, and that could potentially create a real issue here.
Yes, and I know that again, there's a lot of your viewers say, "Oh, I don't want to hear this stuff. You guys have been wrong for so many years." And as you so often pointed out, I alluded to this just a moment ago, the lag effect. The lag effect. Why didn't things deteriorate? Because there's been a lot of these the leading indicators. The LEIs themselves have been warning about a recession in the yield curve for years, and it hasn't happened. And there's a tendency to go, well, it hasn't happened, so it's not going to happen. Well,
right.
You got to look at why didn't it happen, and there's just very little doubt it was primarily because of these massive federal deficits, the fiscal stimulus.
Right. Well, liquidity in general, right? There are lots of different
liquidity in
sources of
general,
that, right?
absolutely.
So
Liquidity,
creating a
that's
reverse
true.
repo program, spending from the TGA. I mean, just there was a lot of, as Michael Howell talks about, not QE, and not yield curve control, which is all going on sort of stealthily in the background.
Exactly. But that's going away. And those things never last forever. I mean, liquidity-driven markets are fun when you're in them, but you have to realize they are, to use Jay Powell's favorite word at one time, transitory. They just don't persist. So yeah, I think there's a multiplicity of things, bad things that we've been avoiding, or we've been using all these gimmicks to defer, and now they're coming home to roost.
Okay, so we're going to start wrapping it up here. We're over the hour, and again, David, thank you so much for doing this. It's been a great discussion. And folks, if you've enjoyed it, please let David know in the live chat here. And sorry, folks, there was just so much to talk with David about. I didn't really get to the live chat. I will pull one question. So, folks, if you got a question for David, start asking them there in the live chat, and then I will try to pull one as we wrap up here. Real quick, David, let me just let folks know that. Like I said, until 2 weeks ago or less, you were the chief investment officer of Evergreen Golf Call. You're now freed from that, which is wonderful because we get to get the full unplugged, uncensored David Hay. For folks that want to follow you and your work going forward, you've got your Haymaker Substack. Is that the place they should go?
Yes.
Okay. I'm putting up the URL right here.
Thank you for that. Yes, that's our newsletter, and we do put out some free content every week. So we have a paywall like everybody else. I'm trying to do this. I think it was F. Scott Fitzgerald said there's no second acts in American life, and so I'm trying to prove him wrong. But it's really, I don't know. I'm really doing it right now. It's a nonprofit, but I think partially because we have had, as you alluded to, these handcuffs on as far as what I could and couldn't say. I know it frustrated a lot of our readers. So it's nice to be a lot more specific with things that we like and don't like. But I will say that, because we do, like you, have so many do-it-yourself investors, I don't think it's fair to put the burden onus of a specific stock recommendation on a newsletter writer. I think people have to do their own research. I'm willing to do that with sectors and styles with ETFs, but with individual securities, what I like to do is just say, look, I own this personally. This is why I own it. And you make the call, you do that, and I'll provide you the information I can give you, and then you take it from there. But yes, we'd love to have more subscribers. It's now become my main gig.
All right, and I think we've talked about this in previous appearances of yours, David, but you do a really good job when you are sharing the companies that you're looking at. I'm sorry, I'm blanking on the categories. You can tell folks what they are. They go with the whole boxing theme.
Right.
But you make it really easy for folks to kind of know your level of confidence in the type of investments that you're suggesting people consider.
Yeah, we're actually kind of taking that to the next level up because the handcuffs are off, or the gloves are off, I guess, to use the pugilistic analogy. But so we're really, we're going to have model or template portfolios anyway. It's more specific by recommendations, much more specific with the ETFs and asset classes than with individual securities. But there's going to be a long shopping list of individual security, including, which my bad in not mentioning this, which I think is the big thing we bring, because as you know, we really focus a lot on income generation, which very few of our peers do.
Right.
That's always been my specialty. I mean, I've always been focused. The two main areas of focus for me have been income generation and then the energy hard asset area. A lot of times there's an overlap. So, we really, when we unveil these income portfolios, I think for a lot of your readers who, if they say, look, I'm not going to be making these kind of stock market returns, I need to have cash flow to get me through my retirement years. And unfortunately, I think that mindset has gotten lost during all these years of the mega bull market.
Mm-hmm.
So cash flow, I think, is going to be very critical going forward.
So, David, I know there's a lot of interest in this topic amongst my audience for sure. We've had Stephen Bavaria on in the past, and he's written the book, the Inside the Income Factory. The Income Factory is sort of his framework for doing this, and those videos tend to get a lot of interest. We had one interview with you and one of your colleagues there, Jeff from Evergreen Golf Call. We should probably do a few more with you in the future, on the topic of income investing. And folks, if you'd like to see more about that, let us know there in the live chat and in the comments. And if there's enough strong interest, we'll maybe prioritize doing that sooner rather than later. If David, you're open to that.
I'm open to it. And also, since you brought up Jeff, I just wanted to correct that he's been the co-CIO at Evergreen for the last, 3 years. And so I've been the co-CIO for that same time period. So now he's the man. He's got a lot on his broad shoulders.
Okay. So he's taken over the full mantle. Yeah, it's big footsteps, big footprints to try to fill. All right. Well, look, I've got this question here, David, for you. Earnings season starts on Friday with JPM. They already released terrible guidance. I actually haven't been following closely enough to really know what he's talking about here. I don't know if you have, but in general, given all that's going on, what are you expecting from this coming earnings season?
I think a lot of disappointments. Just like we were saying earlier, I think we're in a phase where the market's going to have to come to terms, which is a typical recessionary epiphany, that we're not going to have positive earnings growth. We're going to have negative earnings growth. Now, there's going to be companies that still report positive earnings. And if you can find those that are not, like a Costco probably will, but it's so expensive, it's hard to make money with Costco. But if you can find a company that will continue to have higher earnings and has a reasonable valuation, that's nirvana.
Okay. All right. Well, look, folks, as we wrap up here, first off,
and by the way, Adam, I'll be writing some of those up.
In here. Oh, you went there on mute there, Dave.
I've got the dogs are getting riled up or something, but I
will.
will. So when you have Stephanie on, she's only got Wilhelmina, one dog to worry about. I've got three.
Yeah, you got three.
I have 250 pounds of dogs. I should have these doors closed, but I had some anyway. Long story, right. but the where was I going with that, Adam? I was going to say something about the portfolio.
You said you're writing up.
Oh, and I will be writing up. I'm doing a screen right now for companies with very high levels of earnings predictability, and then looking for those that have recently broken out. I think that's going to be a very good shopping list for people that still want to have equity exposure, but are mindful of the recession risks.
Okay. Well, it's looking here from the chat that folks are quite interested in this, Dave. So let's try to get you back on again soon to do this. Cool. All right, folks. We'll look in wrapping up here. One of the things that Dave, is a big fan of is hard assets. We didn't get to talk too much about the precious metals specifically, but just want to remind folks we have yet another free guide in addition to the layoff guide I mentioned. If you haven't read it yet, go to thoughtfulmoney.gold. It's our gold buying and storing guide. So if you're relatively new to the precious metals and want to learn all the different options that are available to you, that guide is just a primer. It just sort of walks you through all that. It's just a nice educational resource for folks. And of course, trying to put all this stuff into practice. If you're a DIY guy, great. If you feel confident in your ability to navigate this type of market we have, fantastic. I got to be real honest, and I'll let David chime in on this. I got to feel that there are, relatively few professionals, of David's caliber and tenure who have the experience and the seasoning to really navigate this well. And so I just think that translates into, there aren't that many DIY investors on the retail side who, have a lot of experience with this. And it's not a shortcoming to say, you know what, I might be entering waters that I might not be the best captain of my ship for, right? If you can be, and you've got a good track record and you've got all the qualifications, fantastic, keep doing it. I'm all for it. But if not, this may be a time, especially that looks like it's going to get pretty rough going forward, potentially, to leverage, a professional captain who's got experience doing this. And if you want some help, if you don't already have a good financial advisor who can play that role for you, then, consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. And if you want to do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. And set up one of these free consultations. They're totally free. There's no commitment to work with these firms. They'll just sit down with you, hear about your personal situation, and give you their best advice. And you can do whatever you want with it. It's just a free public service they offer. There's really no downside. So anyways, go to that if you feel that would be a positive next step for you. And David, I'm curious just your thoughts on this, because you've dealt with investors for decades. There definitely tends to be a hubris, I think, that develops when times are going right. It's that old John Hussman, I think he said, bubble markets force you to make a decision, look like a genius now or look like a genius later, right? And everybody feels like a genius when the bulls are running, right?
Well, yes, and there's an old axiom, probably goes back to the 1920s, never confuse brains with a bull market. And I think people do that way too often. So yes, you're right. And I do think there are a handful of people that really, they've developed some good trading systems. I think they have things like, they'll look at Fibonacci, they'll look at 250-day moving averages. They'll look. I found very few people look at breakouts and breakdowns, which is why I like to do it. They all kind of acknowledge it, with lip service, but nobody really. It just seems too simple, but it just keeps working. Okay. And for somebody like me that has lost a lot of money shorting companies that were breaking out, and has finally learned when that happens, you just cover, no questions asked. It's and as I said, it happens with a wide range of data. But I think to your point, very few people have the ability to do what we just said. I think it's very critical to acknowledge your weaknesses, and it's not something to feel bad about. I mean, this is a very complex business, and I would also say, as I've talked about before, that when you get into the income world, it gets even more difficult. It's very, very hard for individuals to even buy a lot of these bonds. And then when you start mixing in emerging market bonds and pipelines and things like that, it's I really do think it makes sense to hire in. I can say this unbiased now because I'm no longer an employee of Evergreen.
Right.
I still like Evergreen, and they do read my information. So if we have any Evergreen clients listening, as you know, they're still reading my dailies. They read everything I put out. So I'm still influencing their thinking. But at this point, if they don't like what I say, they can feel free to ignore it. And I'm sure they will at times.
I doubt they will.
Oh, they will.
Yeah.
I'm not always right, Adam. I'm not Nancy Pelosi.
Yeah. Well, last point on this is that where was I going to go with this? Yeah, it's kind of in my brain. But no, that's what it was. Which is, what I find one of the biggest benefits that a good professional advisor can bring is simply just the discipline, the framework, and the discipline of doing some of the things that you were talking about earlier, David. Right, which is, the position sizing, the rebalancing, the dollar cost average, like all these things that it's normal people, we just get too busy with life to really stay on top of. And even that alone, right, has a ton of value, right? And obviously a lot of these people, like you do, and you did at Evergreen, is you have these frameworks where you may feel really emotionally strongly about a trade, but if it's not ticking all the boxes of the framework that you set up in advance, that's a discipline, that's a constraint that keeps you just from going with your gut on everything, right? And if you've got a good framework over time, it's going to win more than it loses, right? So it's just that sort of discipline. And again, being super transparent for folks, the vast majority of my net worth is managed by financial advisors. I don't do it myself because I'm honestly too busy. I'm too busy, talking with guys like you every day, Dave. I buy stuff and then I forget why I bought it, and I look at it, a couple quarters later, and I'm like, why is this in my portfolio still? And to be honest, and I'll be really transparent about this, I interviewed people who are wicked smart, way smarter than me, and they don't always agree. And I can interview somebody and they can tell me why they're dead certain that we're going to have higher inflation going forward the next couple of years, and I can be convinced by that. And then the next day I can talk to somebody like a Lacey Hunt who says, no, look, it's going to be disinflation and deflation all the way, baby. And I'm convinced by that. And it's very easy to get whipsawed by this. So I need to have somebody who's got a framework that doesn't get emotionally influenced like that.
Well, maybe they're both going to be right, just at different times.
Just at different times. Yeah, exactly. All right, my friend. Well, look, it's been wonderful. Folks, again, if you've enjoyed this, please let us know in the live chat and then in the comments. And of course, we'll have David come back again in the future as much as his schedule will allow. And I do like these live streams. We've been doing a fair amount of them recently to react in real time to what's going on. But folks, if you do just like the live stream format in general, I might just start doing more of that anyways, because it is fun to get the real-time feedback from folks and being able to take a live Q&A when time allows. David, can't thank you enough, my friend. I'll let you have the parting last word here to the audience.
Well, I just want to say thank you, Adam, and I think you're the best in the business. You really are. And I mean that absolutely sincerely, and I congratulate you on the success of your channel. And I think the reason you're so popular is because you are so balanced and you are so affable, and you just bring out the best in your guests. And thank you that I'm one of them. It's a real honor.
You're the kindest man. There's a fresh baked loaf of sourdough on its way to you now, Dave.
Love it.
Mention. But no, thank you. And look, the only thing I'll say in response to that is all I try to do is own my role as the avatar for the person who's watching this video. I just try to think, what would they want to ask if they were sitting in my seat? I'm just the guy who's lucky enough to be able to do it. So anyways, I very much appreciate both the kind words, but also your support of this channel by being willing to come on it, Dave. I know you've got a lot of choices of different places to be, and I really appreciate you being here on Thoughtful Money.
Well, I will say I'm not taking many of these invitations anymore, but I'll always take yours.
Yeah, you're a very kind man. All right, well, folks, look, please let Dave know how much you appreciate him. Please hit that like button and then click the subscribe button below, as well as that little bell icon right next to it. Dave, it's been just an absolute honor and privilege. Thank you so much.
Thank you,
everybody else. Thanks so much for watching.